Started. Good afternoon, everyone. My name is Darren Johnson, Senior Investment Consultant at St. James's Place. I'm delighted today to welcome you all to our latest Fund Manager event, this time with Sunil Thakur, Senior Investment Manager at Sands Capital, one of the managers of our Global Growth and Global Quality Funds. Sunil is dialing in from London today, traveling over from Washington, DC. I've been fortunate enough to interview Sunil both in 2020 and 2021 in these formats. So I know that viewers will get an honest and upfront appraisal of what's going on in the funds and the wider world. Now, for many years, this has been one of the most popular strategies we've had amongst St. James's Place investors. And in terms of timings, I can imagine that the questions posed from the audience will range from the fund itself to events around the world. Our aim is to simplify what we can, make sense of the investment side of things, and maybe give you some insight into some of the underlying companies in which your money is invested. You'll understand that we're here to talk about economic and market issues. So while we're focusing on that area in this interview, we're certainly not downplaying any humanitarian or societal side of things on world events that we all see on the news over the past year. For obvious reasons as well, we can't necessarily go into party politics as much as some people would want, but we will link a lot of what's currently going on in the world to the companies in which the fund invests. This will be the usual format for those who've dialed into previous events we've held, and I'll be making sure that this is as interactive and as varied as possible. We have had a lot of questions submitted before the event by investors, which I've tried to group into key themes. And you can submit further questions during the event via the Q&A section at the bottom of your screen. These sessions work much better when they're tailored towards what you want to be discussed. So if there's anything on your mind, pop that over and I will ask that on your behalf in the time provided. It's worth mentioning that also due to regulatory reasons, we're unable to make predictions, give advice, or answer anything specific about your own personal situation. But where those kind of questions are submitted, they will be given to your St. James's Place partner to come back on. So let's get into this, Sunil. Thank you for joining me. Like I said, welcome. Thank you for joining. While we give people time to put questions in, can you give a brief introduction to your fund and the way you manage money on our investors' behalf?
Yeah, absolutely. Well, first, thanks everybody for joining. And it's been a very enjoyable partnership with SJP over the years. I think we're well into the second decade, and that's over half my time at Sands Capital. Just by way of quick background, I've been at Sands for about 20 years, have spent most of that time co-developing and co-managing our global equity strategies. And there are two strategies that we offer that are used by St. James Place in different fund structures, but they are both long-term oriented business ownership approach to owning growth equities. We have one strategy that we call Global Growth and another strategy that we call Global Leaders. In simplistic terms, you can think of Global Growth as being a bit more high octane and aggressive, targeting higher growth businesses, and Global Leaders is more of a quality growth portfolio, to use the industry term, that's going to have a higher proportion of cash compounders. But at a high level, the way I would describe our investment approach is that we want to take a private buyer's mentality to owning public equities. Our belief, and we think the empirical data supports, that the overwhelming amount of equity return is driven by earnings growth over time. And if you can buy a small number of high quality businesses that are best at what they do, that have attractive underlying economic models and have large competitive moats around the franchise, that's a good recipe for owning businesses that can compound earnings at above average rates for the long run. And if that happens, you get great earnings growth, and as a byproduct of that, strong stock price returns. But really, it's adopting that business owner's mentality to owning public equities rather than frenetically trading them every time the multiple moves a few points.
That's really useful background to those who aren't familiar or haven't heard you speak before, Sunil. So thank you for that. I like to break these things down and throughout the next 45 minutes. So where we've been, where we are, where we're going. So unfortunately, we're going to have to talk about where we've been, which is probably talking about all the negative headlines that people have read about the economy and the market and all the doom and gloom that there constantly is. But I think one of the questions we had pre-submitted sums it up, or I quite like the conciseness of it, which is, how do you sum up the last 3 years now you're looking back on it?
Yes, if I had to pick one word, I would say unpleasant.
I was hoping it was going to be a word like that rather than worse, but yeah.
Tried to pick a word that was suitable for a larger public audience, but unpleasant to say the least. But, an unfortunate reality is time periods like what we have just come through are an occupational hazard. They are a natural part of equity markets over time. And if you look through history, the story is always a little bit different. The details are always a little bit different, but the idea that there are ups and downs and sometimes severe downs in equities and in any asset class, ultimately, it is tried and true. And that's why a prudent portfolio is going to have diversification across different asset classes and styles. But I think if I were to break down the last few years in a simplistic framework, I think really two things happened. We got a bifurcated market on the back of COVID, which basically separated the market into digital-based businesses and analog-based businesses. The analog world shut down. The digital world accelerated. And you saw the impact of that in stock prices. Now, some of that was cyclical acceleration, and some of that was just accelerating secular trends that were already underway. And so think like e-commerce. Can't go to the grocery store, pull forward in terms of that secular shift of not going to the store anymore and having it delivered to your home. The second thing that happened on the back end was, after a generation of low rates, a normalization of interest rates across the term structure and across the capital structure. And that led in equities to a structural reset in valuations. And those two dynamics, I think, are what really describe the bulk of what happened at a market level over the last couple of years. Now, underneath that, you have a lot of company-specific things that were going on. And as cherry pickers, we get buffeted around by the stock price and valuation implications of what I just described. But at the company level, there's a lot of stories around competitive moats getting stronger, investment ongoing, earnings continuing to compound. But it's very difficult to see that show through in the market environment we just had. And I think it's a combination of COVID and then a structural reset in the term structure, which led to a structural reset in equity valuations.
We'll dig into some of those companies in a moment, because I think that will probably answer some questions around whether returns are likely to be better going forward than backwards. Obviously, we can't make any predictions on that or talk about people's circumstances personally. But ultimately, I think some of the companies, and digging into that, will answer why we think that things will improve going forward. But continuing the where we've been situation, I'm not going to make assumptions of how long, but presumably you've done this a while. You've done your job a while. And one of the questions we always get is whether you've had to adapt to the modern world along the way, and how you manage money. Is it different today than it was 10 years ago, for example? Or is the consistency part and parcel of what you do, i.e. whatever market conditions are, you keep doing the same thing?
So yes and no. I think philosophically, not one thing has changed since our founder, Frank Sand Sr., opened the doors over 30 years ago. We think there's really three preconditions to a great business that can compound earnings over time. Leadership position, so be the best at what you do. Operate in an inherently attractive business space, strong underlying economics, build a big competitive moat around the franchise. That is what we've always looked for. It's what we still look for. And 10 years from now, that's what we're going to be looking for. The execution of that process, I think, is always evolving. And some of that is where you are with your team and your people. A lot of us grew up together professionally at Sands, and we're at different places in our career today than we were 10, 15, 20 years ago. We're harvesting a lot of dividends that, 15 years ago, a bunch of kids out of college are now senior investment professionals. We have a team that has been together for many, many years. That changes the way you work. We've changed the organizational structure of the investment team over time. We've resourced the investment team differently over time. But the fundamentals have always remained the same around investment philosophy in terms of what we're looking for. But then also, I think equally important and often overlooked when looking at investment managers, the way we think about culture and team. So just as one of the uncomfortable realities in our industry is, if you're really, really good, you win about 55% of the time. If you define winning as a stock goes up more than the benchmark while you own it, which means you lose 45% of the time. So we engage in an endeavor that has failure at an uncommon, where failure is uncommonly common. How do you structure a team that can navigate that and still engage in prudent risk taking? And we think a lot of that boils down to trust, chemistry, candor, economic incentives. And so we've tried to build a structure where PMs are involved in the frontline research with analysts. Analysts are involved in the decision making, both at levels that would be uncommon in our industry. And that drives a sense of shared ownership, a shared context, trust. And ultimately, we think that that drives better decision making and returns, particularly in difficult environments. So in the last couple of years, very challenging environment. Personally, professionally, financially, it's just hasn't been a great couple of years for what we do. But I would look back at the decision-making environment for our team, and I think it remained very, very strong. And that's the value of building that culture up over a long period of time. So philosophically, nothing's changed, and it's not going to change. A disproportionate amount of the reward in any industry accrues to the leaders in that industry. And it's a lot easier to compound earnings in an industry that is inherently attractive versus one that is not. And that's a reason we're concentrated. That will never change. And then that cultural element of investing, I think, is critically important. But the tools, the organizational structure, the execution, that moves around over time.
So finishing off the where we've been and finishing off the negative economic stuff, put simply, should talk of a recession, whether it's global, whether it's in the UK, whether it's in the US, should a talk of a recession concern a long-term investor?
In my opinion, not at all. And that's not to overlook or dismiss the very real impacts that has on people, on operating environment for businesses. But when you think about a recession, I'd offer a few thoughts. One, they're natural. They're a natural and unavoidable characteristic of the business cycle. So we're going to own a business for 10 years. A recession ought to be baked into your investment case. It shouldn't be a surprise when it happens. It's going to happen if you own assets for a long period of time. Then I would just make a quantitative point, which is current earnings power is a relatively small percentage of the total value of any business. So if you think about, just rough numbers, you have a stock that trades at 20 times PE. I do that to keep the math simple. Well, only 5% of the value of that business is this year's earnings. And the next couple of years is still a massive minority of the total value of an enterprise. So if earnings are going to dip by a few percentage points or even get cut in half for a year, if the underlying fundamentals of the business have not changed, then that recession is almost irrelevant to the intrinsic value of that security. Now, we know that equities as an asset class are much higher volatility, and stocks react in a disproportionate way. That's because investors on average have short time horizons. But if you really are thinking in textbook terms, what is the value of an equity asset? Recessions just shouldn't be that big of a deal for their total value. The second thing is more of a philosophical point, which is that recessions, painful as they are also great for clearing out the underbrush and shaking out the weaker players in an industry. Cheap financing goes away. Good times can cover up a lot of sins, but as Warren Buffett always says, when the tide goes out, you find out who's been swimming naked. Well, if you own the companies that are leaders with big competitive moats, those companies can keep investing. And then you come out the other side of a downturn with a wider competitive moat than when you went in. And we think that's exactly what's been playing out over the last couple of years. That hasn't always been a technical recession, but it's been a challenging operating environment for many businesses. And you're seeing that from food delivery to content delivery. You're seeing it in physical markets like aerospace and the like. Everything slows down in a recession, but the best come out stronger.
Somebody's just put something in, which I'm not sure is a question or a statement, so take it as you wish. Is a recession a good price to pay for decreasing inflation, and ultimately stocks and equities benefiting from that?
Again, setting aside the real world dynamics of politics and human impact, my view is yes, absolutely. And the reason is a recession is temporary. It's essentially an economic mechanism that corrects imbalances that have built up in the system. Imbalances become more corrosive, more dangerous, more risky the longer they're allowed to persist. And so I think recessions are sort of it's kind of like a forest fire. It's sort of a healthy cleansing cycle.
So let's get onto the fund itself, and the holdings. And
I also don't have to run for public office, so it's easy to say that.
Helps. Yeah. What does your valuation of your overall fund look like relative to historic valuations, and indeed relative to the wider market? Is the market expensive, cheap? Is your fund expensive, cheap? Where do we sit at the moment in terms of valuation?
I think we're basically right in the middle. I wouldn't say that we're at any sort of extreme in terms of expensive, but I'm not going to run out and say it's table pounding cheap. My own view is if we get the earnings growth of the underlying businesses, we're going to have a really attractive absolute and relative return looking out over the next 5 years. I think it's a great time to own and to commit incremental capital to a strategy like ours. But I'm not going to run out and say it's super cheap or expensive. I just think we're at very normal valuations for the kind of assets that we own. And all of the definition of normal has been reset down a little bit. Put some numbers on that. We've got our global growth portfolio, the more aggressive of the two, trades on about 30 times earnings, and our global leaders portfolio trades on about 20 times earnings. Now, mind you, those are going to be well above benchmarks like the ACWI that are going to be in the mid-teens, but we also have portfolios that are growing at much higher rates. So the weighted average earnings growth rate in global leaders will be in the high teens, approaching 20%, and in global growth, that would be in the high 20s, approaching 30%. So we think we're paying a fair price for very high quality assets.
In terms of how useful PE price earnings ratios are relative to history, I think in today's world where technology dominates pretty much everything and technology companies trade at much higher ratios, is that still as useful as it was, or is it just one gauge amongst many?
I mean, it's just one gauge amongst many. I'm a particularly big fan of free cash flow because cash is real money you can put in the bank. But PE is useful as a construct. I actually think the usefulness of PE or lack of usefulness is more a function of the company's growth rate than the type of company it is. Because at the end of the day, the whole point of starting a business is to generate free cash flow and to generate returns in excess of your cost of capital. That's the whole point of running a business. They come in a whole bunch of different shapes and sizes. So tech company or non-tech company, the ways of looking at that profitability and that value should be the same. Tech companies tend to trade at higher PEs because they're asset light, inherently higher return businesses, oftentimes have non-physical moats that have network effects or things like that can bring a lot of comfort. So they're generating higher returns on invested capital when you find the successful ones. Often are generating a lot of free cash flow. They may be reinvesting it in the business, but if you were to look through to the underlying economics, a lot of free cash there. And they tend to be growing at substantially higher rates, at least the ones that sort of are the basis of that comment. So, but those PEs, for many of them, in our view, are justified. If you walk through and you say, what's the asset intensity of this business versus, say, a manufacturing business? What's the cost of capital versus the return on capital, comparing across industries? So I think PE is still useful. The issue is that valuation is treated like a linear concept, but it is not. So a company growing at 30% per year should not have twice the PE of a company growing at 15%, all else equal. It should have more than twice the PE because of the impact of compounding. So, and then you layer in the false precision that comes from doing a discounted cash flow model or something like that. PE really loses its usefulness as a practical tool when you get to the higher growth rates. But I think at the end of the day, we want to be investing in the kind of businesses where, for the most part, PE on the earnings and the earnings power going forward is a relevant metric. And if it is at a stage in its life cycle where it's not a relevant metric, we at least understand what the underlying economics are and can think through what a PE should look like in the out years.
Indeed. Apparently, there's a couple of people who've had sound issues, so I apologize for that. But hopefully, it's not for everyone. Let's carry on. Let's dig into some of the holdings. You mentioned high PEs, so let's start with a couple which have high PEs and have been in the news a lot lately. So the big tech companies have been in the news. So I've picked out a few that you hold, and I'd be quite interested to see what you think of what's been going on this year, but also looking ahead. So let's start with the one that's mainly more in vogue than anything else is a company called NVIDIA, which I'll let you, for those who haven't heard of it, most people will have done, but if you haven't, I'll let Sunil introduce what it is and why it's held. But can we start with NVIDIA? Because I think then that gives us a way into some of the other tech names as well. So yeah, let's start with that.
Sure. So NVIDIA is the company that makes the critical component to enable artificial intelligence and machine learning. So they make what are called GPUs, which stands for graphics processing unit. And that graphics processors that we've had in our computers for many years turned out to be the perfect technology for the computing requirements necessary to make large-scale AI, training AI models in particular, economically viable. And so, and they are, for all intents and purposes, effectively a monopolist in selling GPUs to drive AI adoption and allow language learning models to actually learn. So that's what NVIDIA is. Our view is, and the reason we are shareholders of NVIDIA, is we think that is a durable competitive moat. A lot of times you see the competitive advantage erode around a fabless semiconductor company. So a company that designs semiconductor chips, but is not vertically integrated, does not actually produce them. So for years, the choke point, still one of the choke points, but the choke point has been on the manufacturing side and the tools side. But NVIDIA has linked their hardware with their own software libraries that create not a walled garden, but really accelerate the ability to develop and train large language models and AI models, that we think that's going to create a very robust competitive moat around the franchise. And then they're just innovating and improving at a faster rate that makes it. And you see this with leading businesses quite often, that when you are the leader, you have the ability to innovate faster, which means you can run faster, which means you can expand your lead naturally over time because you're starting from such a privileged position. So that's where we think NVIDIA is. But we have a number of investments across the semi supply chain, because the one thing that's very clear to us about AI is it's going to require a lot of everything. And a unique characteristic of the semi supply chain, and maybe the only other industry where you see this a lot, is aerospace. There are a number of monopolies at the key choke points. And so expanding from NVIDIA, we have investments in companies like ASML, ASM, LaserTech, Taiwan Semi across our firm. And the reason is that all of those businesses across the whole semi complex are poised to benefit greatly from the advent of AI. But NVIDIA is clearly sitting at the most critical choke point at this moment in time.
It's really good context. Let's move on to another one of the tech names, because that's what people are hearing about. So that I'm going to make the assumption that's what that some time would need to be spent on that. So the next one is Amazon. Amazon may feel like an obvious stock to a lot of people, but I can assure you that within our fund range, not everyone is keen on Amazon, and that's what makes a market. Some people are, some people aren't. But seemingly you are, and therefore let's discuss the for side of this. So yeah, Amazon.
So we've been shareholders of Amazon since 2006, and obviously the company's evolved a great deal in that time. It's a much larger scale. We think Amazon has won its market in all of the relevant geographies where they have a significant presence. And now the company is going into a stage of its life cycle where incremental growth will drive disproportionately higher incremental returns and free cash generation. And the reason is what they have built out is they've had product density for a long time. Now they have vertically integrated to where they have route density and the ability to deliver very efficiently on the physical side of the business. Still delivering physical goods to people's homes. So is it a tech company or is it a logistics company? That's, I think, a fair debate. I think it's a logistics company with a website. But because of that route density, when you have high route density, you can layer on incremental sales, incremental purchases at high incremental margins. And we think when you pair that's the retail side of the business. They also become a magnet for advertising because they are the center of gravity, jumping over Google in many cases, the center of gravity of discovery in the retail world. So that's extraordinarily high incremental margin. And then lastly, you have this paired with a key piece of global internet infrastructure, Amazon Web Services, which is highly scalable, and you're continuing to see a migration from on-premise computing to the cloud. So more and more companies are adopting Amazon's infrastructure. Same thing with Microsoft Azure's infrastructure. Amazon and Microsoft are really the two big winners in cloud infrastructure. And when you put all that together, we think Amazon's a very compelling package with a lot of growth still in front of it. Not the kind of growth we saw over the last 10 years. It's moving more into that steady compounder phase of its life cycle, but we think the valuation reflects that and is relatively undemanding.
And growth of a company that size is still substantial growth, isn't it? So it's people forget that. I think it's not just the number; it's the weighted number of amount of growth as well. Moving on to one of the other tech names, and I promise we're not going to go through every single one, but I do think these ones are particularly relevant. Netflix is again not traditionally within our fund range for most investors. People seem to have a love-hate relationship. It seems to polarize people. But Netflix certainly seemed to be written off in the press and the media during 2021, 22, to the point where most neutrals would think it was going to go out of business. Can we discuss your holding in Netflix and why it continues to be there?
Yeah, absolutely. And I think this is one where if we had it to do over again, we probably would have exited the position a couple of years ago at sort of peak Netflix, but we might find ourselves buying it back here in the recent past. And a lot of times when you own a business for 5 years, 10 years, 15 years, we've owned Netflix for going on a decade. Companies go through a phase transition from that hyper growth part of their life cycle to more of the compounder part of their life cycle. Sometimes that is a smooth transition. Sometimes, particularly when the valuation is elevated, that can be a rough transition. Netflix's was a rough transition. Part of that was they got the COVID bump, both in terms of business results and in terms of valuation. And then in later 21, 22, you started to see incremental competition. So Disney Plus, Amazon Prime getting more and more traction. Our view on that has always been that there is a broader secular shift away from linear TV to where most consumers will have multiple streaming services, typically with Netflix at the core. So it's going to be Netflix plus some others, not others in lieu of Netflix. That's been our view, and I think that's largely been borne out in the data. But incrementally, some competition. They also hit a growth wall, and we were all surprised by the amount of account sharing that was going on in the Netflix user base. And once we understood the level of account sharing, you could see that the company was more penetrated and closer to a growth wall than we had believed. And then this is going on at the same time. There's a broader valuation reset for assets like Netflix. Our view is that Netflix has come through the other side of that. It's still a high quality business. All the competitive advantage that it had historically is still there. They've adjusted to this growth wall dynamic by introducing an ad supported tier that has been very successful thus far. So they're doing a much better job of segmenting the market to continue their user growth and doing it in a way that monetizes as attractively as their base business. And we've seen a normalization of the cost structure in terms of content creation. And so difficult experience over a couple of years. It's also up over 60% over the past year.
Yeah. And I'm sure there's no one listening who's ever shared a password on Netflix or That's certainly not anyone here. But look, I think it's always important to talk about what hasn't particularly gone right as well.
Mm-hmm.
I think it's very easy to run these things and go, oh, look, what's gone well. It's been a tough year, tough few years. But I think it's important to talk about what hasn't gone right, but also why it's still held and why we believe, mm-hmm. or you believe and your team believes that things can improve going forward. So they're the only tech names I'm going to discuss. Mainly they're the questions that people had. I'm going to take a slight left field turn to another stock here, which is, let's go away from the US tech names and let's talk about a UK one. When I was going through the holdings list, Rentokil stood out. So you see all these tech names of these global multinationals, huge things. And then I saw Rentokil. So can we discuss that? Because I assume that most people on this call will recognize or relate to that company, and therefore, can we discuss that?
Absolutely. So Rentokil is a literal cockroach of a company, and they sell. The joke on Rentokil is the bugs don't read the news; they just keep on coming, and you want to get rid of them. And one thing that I think we talk a lot about AI, we talk a lot about disruptive innovation happening in technology. But a point I often like to make is that oftentimes physical competitive moats are even stronger than digital competitive moats. And Rentokil, I think, would be a perfect example of that. Bugs and other critters that are unwanted are a physical phenomena that require a physical solution. And Rentokil has the largest global scale of any company in this space. But if we look at the industry of pest control, it's a relatively fragmented market, even with a big player like Rentokil. It's an economically resilient business space. Even in a downturn, it's a relatively low cost relative to the value it provides. You don't just cancel your pest control because you're making a little bit less. And then you've got growing demand. Unfortunately, things like climate change and the like are increasing the geographies where you have different types of pests. And then as you gain scale and build your route density, which pest control is really a route density business. We take a truck, we send it somewhere. How much stuff can that truck get done? And that comes at higher and higher incremental margins. So that naturally drives up your ROIC over time. And they're in the middle right now of closing what we think is going to be a surprisingly good acquisition, which is an American company called Terminix. So Rentokil is still a UK-based business, but it's disproportionately levered now to the US pest control market. And but we think there's going to be a lot of hidden upside there. Biggest reason being the route density that Terminix is going to layer onto the existing Rentokil footprint. But the other thing about a company like Rentokil, beyond the specifics, is the role that it plays in portfolio construction. And our view is that a prudently constructed portfolio is going to have a diversity of assets, a diversity of business drivers, but also a diversity of growth cadences, if you will. And we're going to have distinct profiles between our two flavors of global equity, global growth and global leaders. But the broad principle of having a diversity of growth drivers, diverse exposures that will stabilize the portfolio when other parts are bouncing around, Rentokil plays that kind of role very effectively.
I think it's useful to go away from the norm as well. I think it's a company people can recognize, but also it's not on the routine list of companies that people discuss. And I think it's important that, again, with active management, that we're looking outside the obvious, outside the headlines and keeping an eye on these things. So, on some of the stocks, so people, before we go on to what next, we've had some questions while we've been talking about these things. And I think there's a theme coming, certainly when you were talking about US tech names. And I'm conscious that when I say tech, that's a sweeping brush, but somebody's asked, what's your take on US tech valuations over the next 18 months based on the position taken by the Federal Reserve?
I think most of the air is out of the balloon, that we are back to, whether the Fed is done raising rates or not, the structural reset has happened. And there's a certain, not to get too technical, but if you think about bond pricing, there's a certain convexity to valuations as well. so that it's those early rate increases that have the biggest downward impact on valuation. And then the incremental ones that come along towards the end of the cycle are just mathematically going to have a smaller impact on valuation. But I also think everyone's gotten the message. The Fed's going to do what it needs to do to get inflation back to target. And whether rates are there yet, you ought to incorporate that into your valuation thinking. So I think, tech valuations have reset. Doesn't mean that every company that has been funded with free capital has run out of that free capital yet. So you could still see some business unwinding happen among weaker players. There's still some competitive environments that are yet to normalize. But if I broadly look at U.S. tech, I think at least for the high quality assets, which is where we have the most familiarity, so I feel most comfortable making a comment. The high quality assets, I think, are right along that theme I talked about earlier, that I think valuations are fair and reasonable. Not going to make a case that they're super cheap, but I don't think they're uncomfortably expensive either, given the caliber of assets, the return profile, and the growth rates.
Perfect. And that walks me towards, and I'm trying not to go into politics, but that walks me towards other things going on in the US over the next 12 months. And I've had a couple of questions. So
which is basically just politics.
I'm sort of skirting away. I've done these long enough that I know how to divide an audience straight away. So I'm trying to skirt away from that. But I think this probably affects technology in a way as well, in that, how do the authorities deal with companies that get to this size? But somebody's put very simply, what does either outcome in the next US election do to markets?
So I'm personally of the opinion that politics has people tend to overestimate the impact of politics on markets. Maybe over the very long term, the direction of a country as a function of its politics can have an impact. But I've always thought that business tends to go on despite the political environment. And so if we just look at the US, for example, like a lot of geographies in the world, we have a very polarized electorate. I still think most of the country is more in the middle, and it's the extremes that capture most of the news. But the reality is it's a divided country. And I think the roots of that divide are socioeconomic more than anything. And so those are very real stresses that need to be dealt with. To sum it up, I think the U.S. is so divided that it's going to be really hard to pull the regulatory pendulum one way or the other in a big direction. But I also think we have done a fairly good job. We still have this risk on the table, but for the most part, trying to invest outside of the big potential regulatory headwinds. Relatively small exposure to social media. Amazon is a clear issue. But a number of our tech investments tend to be in the enterprise software space and other areas of the tech stack where regulation is likely to be more muted.
Elsewhere around the world, how much time have you spent worrying about the BRICS expansion or the other things we've seen in the news lately, as opposed to the sort of traditional G7?
Not that much. I mean, I think part and parcel to our investment approach is we're cherry pickers. We're trying to find the exceptions to the rule and the one company here and the one company there that is a really interesting growth asset for largely idiosyncratic reasons. And you're always buying the macro environment when you buy into an individual business. So if I were to make a broad statement around the world, I think, we've got I think a lot of this is you're doing a relative comparison where it's the least challenged, rather than saying that a place is particularly great. But I'd say the United States has a lot of nice tailwinds behind it in terms of capital availability, innovation, the kinds of companies that come out. We still invest a lot in the US. Europe, much slower growth backdrop, but a lot of really interesting businesses, especially in the industrial space, that operate in attractive niches where they're big beneficiaries from ways in which the world's changing, like a company like Sika based in Switzerland that makes additives for concrete that makes it more carbon friendly, stronger, more efficient, lowers cost. That's right in front of a whole bunch of secular trends that not big industry growth rates, not big economic growth rates, but something very specific going on in that company's markets. And then, among the EMs, we definitely are most overweighted in India, and then behind that would be Southeast Asia, and then a distance behind that would be Latin America. Brazil is, I think, becoming incrementally more attractive. But aside from sort of those big macro stack ranks, we don't spend a whole lot of time trying to sort through it, because at the end of the day, some ebb and flow is a very natural part of the backdrop.
Yeah. Headlines are short term. You said that about recessions and things like that. Political cycles, even you could argue if someone's investing for 10, 15, 20 years that you'll see 4 or 5 political cycles, for example. So I think the overall context is always useful to put into place. One of the questions I'm trying to put together themes from all the questions we're getting at the moment. One of which is obviously with higher interest rates, everything's relative. But in terms of in this country, in the UK, we're now seeing headlines of 5% cash rates and things like that. Yeah. So a couple of people have asked, is there any chance that actually savings now outstrip investments? I have my own view on that. I'd rather get yours. To me, the risk return line is the same whether the risk free rate is 0 or 5. But ultimately, you must be dealing with that in the US as well. As why wouldn't I just go low risk? Is there is a safe haven even possible at the moment, or how do you see that question and that conversation?
Yeah, I think it's a great question. The way I would first characterize it is, what's your definition of risk? Do you think of risk as volatility, or do you think of risk as a permanent loss of capital? And the reason I frame it that way is, if we think about the high savings, the high interest rates, the inverse of that is downward pressure on valuations. So volatility in risk, in the valuations of risk assets, that will ebb and flow over time. But that, as rates rose, you were taking the hit on your risk assets. When you're on the backside of that is not the time to go away from risk assets. And so there's always nothing happens in a vacuum. And so my own view is, there is no such thing as a risk-free asset. Even U.S. Treasuries are about to be defaulted on. Say that a little bit tongue-in-cheek. Although the last time it happened, Treasury prices went up, not down. But the talk about that for exorbitant privilege. But there is no real risk-free asset, and if you want to earn something greater than inflation, you have to take risk. So then it comes down to prudently and sensibly diversifying that risk through asset allocation. And asset allocation is the one free lunch that allows you to not get bogged down in the details of the cycles and the volatility of each individual asset class, and then each individual asset that you hold within each asset class, which is exactly what your partners are doing, using our strategies as a small building block of a much larger whole. And with that kind of a structure, I think you get to sidestep a lot of these questions and then think very long term. What's the most prudent allocation for this particular client, given their means, given their goals, given their risk tolerance?